You know, in the stock market, some days are pretty quiet, pretty normal, and then there are days that are just explosive. Today, we are diving into a really wild story about a company called Oriental Culture Holding, or OCG for short. And believe me, it's a perfect example of one of those explosive days. So get this, on one single day of trading, OCG's stock price didn't just climb, it absolutely skyrocketed. We're talking more than 291% in a matter of hours. This wasn't a gradual rise, this was a vertical launch. And that, right there, is the big mystery we're going to unpack together. How on earth does a company's value nearly quadruple in a single day? Was it some huge game-changing discovery? A massive shift in their business? Or was it something else entirely? All right, so how do we crack this case? Well, we start by looking at the ingredients that actually fueled this fire. Because, as it turns out, this explosion wasn't random at all. There's actually a very specific recipe for a stock spike like this. Our source material actually calls this the classic recipe for a monster stock run. You can think of it as a three-step formula. First, you need some big corporate news. Second, you need some fresh data for traders to chew on. And third, you need that spark, a sudden rush of attention from the crowd. So let's break down each of these ingredients. Okay, so this is crucial. The company got the green light for two totally different but very powerful actions. On one hand, they could do a share consolidation. The easiest way to think about this is like trading in five $1 bills for a single $5 bill. You have fewer shares, but each one is worth more. It shrinks the supply. But on the other hand, they also got approval for a share increase. And that's basically like firing up the printing press to make new shares. It's great for raising money, but it can make everyone else's shares less valuable. This news was a huge signal to the market that some big changes were on the horizon. Now, for that news to have such a massive impact, the stage had to be set just right, and it was. Why? Because OCG was a low-float stock. All that means is there weren't a ton of shares out there available to be traded. The analogy from the source is perfect. It's like a tiny boat in a huge storm. Even a small push, a little bit of buying, can create a massive wave and send the price flying. So you see how all the pieces come together. You've got this perfect storm brewing. You have the news about major corporate changes, you have some fresh, though unaudited financial numbers, and you have this low float setup that makes the stock super sensitive. All it needed was a spark. And then the crowd showed up. Retail traders spotted the movement, and the frenzy began. So that really explains the why. Now let's get into the how. We can actually look at the trading data from that day, see the frenzy in action, and maybe more importantly, uncover some of the serious risks that were hiding just below the surface. And here it is. This is the forensic proof. This chart shows the trading volume. On a typical day, pretty low. But on the day of the spike, it was absolutely astronomical. This wasn't a few big investors calmly reassessing the company's value. No. This was a stampede. This is the telltale sign of a momentum-fueled event. Maybe a short squeeze, for sure a retail frenzy. Just look at the battlefield from that day. The stock starts out way down here, around $3 or $4. It then launches all the way up to a ceiling of $13, before finally finding some buyers to support it between $8 and $10.50. But check out that danger zone at the very bottom. The 52-week lows was just a little over $1. That just shows you the insane scale of both the potential reward and the catastrophic risk all in one day. And that brings us to this really critical quote from the analysis. This whole event wasn't just about the explosive upside. The very same ingredients that lit the fuse for the launch could also trigger an equally fast reversal. What goes up like a rocket? Well, you know how that saying goes. It can come down just as hard. So let's just spell out those risks, crystal clear. First, and honestly, this is the big one, dilution risk. Remember, the company has permission to print and sell a ton of new shares. Second, regulatory risk. The financial numbers weren't audited, and these big corporate moves mean a lot more paperwork is coming. And third, you have the classic pump dynamic. Any move driven purely by hype can be incredibly fragile. Let's just double-click on that number one risk for a second, dilution. The analogy here is absolutely perfect. Imagine you have a glass of your favorite juice. That's your ownership in the company. Now, what happens if the company comes along and pours a whole pitcher of water into your glass? Well, your drink gets weaker, right? That's dilution. By issuing millions of new shares, the company waters down your ownership, and the value of each individual share tends to go down. This was the biggest, most fundamental risk built into the OCG's story. Okay, so we've looked at the catalysts, we've examined the trading evidence, And we've laid out the huge risks. So what's the final verdict? What was this incredible event really? The analysis here makes a really important distinction. What happened with OCG? That was a speculative trade. It was a short-term, high-risk, high-reward bet based on news and momentum. What it was not was a long-term investment. That's something totally different based on a company's actual business, its profits, its fundamental value. These are two completely different ballgames. And that, right there, is the bottom line. The 291% explosion was driven by headlines, by hype, and by that special low float structure. It was not the markets suddenly deciding the company was fundamentally worth 4 times as much. And that massive risk of dilution, it was always there, just waiting, kind of like a ticking time bomb under that soaring stock price. So, we'll leave you with this to think about. The next time you see a stock in the headlines with some crazy triple-digit gain, ask yourself this question. Is this a signal of a massive opportunity to get in? Or is it actually a massive warning sign of hidden risks telling you to stay away? Understanding that difference, well, it's everything.